Hi everybody, welcome to our short video on break costs. As always, this is general advice and doesn't take into account your objective, financial situation, or needs. You should consider whether this advice is suitable to you. And we also recommend that you read the terms and conditions of any loan you sign and the relevant product disclosure statements, both of which will likely to be quite boring, but very useful to understand what you're getting into. So what is a break cost? Well, good question. So the basics is if you pay out your fixed rate early, you may incur a break cost, and may is important there because that's not always the case. So what does it mean? How much would that be? Very good question. I'll come to that. And please note before we get into some sort of visual explanation of what break cost is, that all banks base their break cost on different reference rates and use different formulas. So check it obviously before you sign on the dotted line. So bank will try to protect their losses if you pay out your fixed rate early. And so let me just explain that. So if you're taking a 3 years fixed rate and you lock yourself, there's some really good fixed rate at the moment, obviously on the back of COVID and some emergency solutions from the Reserve Bank. So the Reserve Bank has done what we call quantitative easing without being too boring. They printed some money and tried to keep the fixed rate low artificially by buying some bonds. So 1.89 is currently what you can get. And if inflation picks up and the economy goes well and the employment is low and the vaccine works and the rate goes up to 2.89, then the bank has agreed to only charge you that 1.89 for the next 3 years. So you are protected. If in reverse of that, the world goes to some dark places and the US invade China because of something in China Sea, or if the vaccine doesn't work and we're all under lockdown for a few years and the rate drops it even further, then it's too bad for you. You have agreed to pay 1.89 for the next 3 years. Where it becomes a little bit tricky is in 1.5 years, if something happened in your life and you got to break that fixed rate, hopefully you won the tax lotto and all is good. If the rate has gone up, then the bank is happy for you to pay it because they can resell the money for more. So they're winning. If the rate has dropped, they will say, well, hold on, you've agreed to pay 1.89 and we can now only get 1.59. We will charge you that difference. So the difference in this particular case is 0.3. So 1.89 minus 1.59. If you've got a large $1 million loan, that's $3,000 per year. You've got 1.5 years left, so you're going to have to pay $4,500 to pay that loan as a break cost. So this is what the break cost is. If you want to understand a little bit more about the advantages of fixed rate, please watch our other video. Thanks very much for watching, and you have a great day.